Hi, this is Sunny Kalsi here. I hope you're having an awesome start to year 2024. Uh, the year 2023 has ended and the last quarter has ended, so we just gonna need to get a market update done for the whole 2023. There was an upsurge in the last quarter of 2023, and you can see that U.S. market is doing good. S&P 500 is up almost 24%, more than 24. Canadian TSX are up 11.75, and Canadian bonds are up more than 5%. This goes to show that there was an upsurge in the last quarter, right? So this goes to show that don't try to time the market, and if you can stay invested for the long term, but because if someone has been out of the market last quarter, they would have not gotten the returns that the market has done for the whole year. The reason that there's a spike in the market is because the conversation has shifted from rate hikes to rate cuts, because the US Fed Reserve came out and they said that there is a good chance that the rate cuts will start. And what happened was that when this, of course, the decision would be data driven, obviously, but everyone expected and started guessing on how much rate cuts would be. Maybe some were expecting 3 to 4 rate cuts, and that what led to a big rally in the market in the last quarter. Finally, there is talk now that rate cuts will happen, and the market has rallied because of that. But the reason, and again, we can also see that the Canadian market is very resilient too in regards to this. And we can see that the Canadian, last time we had a hike in the prime was in July. So that seems like a long time back, but since we were having rate hikes almost every month. So now even the Canadian market will see a rate pause, even though the inflation numbers are, the rate hikes are working on inflation, and you can see the inflation numbers are coming down now. Even though December there was an uptick in there, and also the reason that inflation numbers are kind of sticky, like they're trying to push it towards 2%, but the numbers are a bit sticky right now. And the major reason for the numbers to be sticky is the employment in both countries. Employment in Canada is very good. Unemployment numbers are very low, around 5. They're kind of okay. But US is like 3.5. That's almost like having no unemployment. Like this very strong labor market in US. So basically, if you're in the US and if you don't have a job, it means basically you don't want to work. That's the reason. So gradually, but what's happening, even though there's such a strong employment market in the US, the inflation, the hikes that were done, and the inflation is gradually working in, and it will gradually have an effect on the company's earnings, and there will be layoffs happening, and it will kind of cool down the market. And once this will maybe give us a soft landing in regards to recession. And if once this starts happening, there are layoffs happening, the earnings of the big companies are going down, then the government will step in with rate cuts. So that will kind of stabilize the market too. So what are our opportunities in this market? Again, the opportunities are fixed income and dividend paying companies, so stocks. So basically fixed income of bonds, the money that that is lended to the government or to big corporations, and again dividend paying companies. So there are good companies both in US and in Canada, especially in the tech sector. Like we have TELUS here, Bell here, and we have Facebook, we have Microsoft, Apple. These companies have been performing very good and have been giving out decent dividend compared to like the regular companies that are not tech companies. The dividend ranging like 5 to 6%. And on the fixed income side, on the bond side, even the bonds are performing much better comparatively to say to a GIC. So bonds are a much better option, especially when we will be start having rate cuts coming in. Fixed income bonds will be a very good opportunity for us to invest because as we see, bonds have an inverse relationship with the interest rate. So what happens is that, say we had bonds, say last year or year before that, or even current year when the interest rates are high, and once the interest rates start going down, these bonds will be valuable because the high interest they will pay, they are paying every 6 months. So they will be more attractive to you to be purchased in future. So not only we will get a decent return on the bonds, also we will be getting a capital gain, a growth on them, just because of the interest rates going down and making the current bonds more valuable. So that will be a good allocation to have in our portfolio. Bonds can be a good, good percentage down there, and they will for sure will be giving us a decent return. And like I said, they can be a much better, attractive, more attractive option than say having a GIC for 4 or 5%. Also, if you look at the S&P 500 for last 50 years, the index, if you look at 1972, is at 118, and right now it's at 3,840. That is a 32 times growth in it. So, and of course the earnings are high too. So basically, if you have, what it means that if you had $100,000 in S&P 500, in these 50 years, they would be worth $3.2 million. So if you look at if you look at short term, how the market reacts to speculation and news, then yeah, of course we can say, hey, market is going up, down, or the companies are not giving a good profit. But if you look at long term, all these companies, especially the tech companies, they are giving a decent dividend out there, like almost 5-6%, and the market is going up in a steady straight line up. And the only reason, if you look at day-to-day speculation or day-to-day news, then of course we can say, hey, people kind of say what the company is doing, what's the performance of the companies. But if you look at the long-term growth of these companies have been doing very, very good. And the main reason why these companies have been doing good, the productivity growth and innovation is there. For example, if you look at the US market, of course, it's the biggest economy we have here, and the technology available to the companies for the people to work, the resources are lots of resources down there. So whatever production has gone up, whatever resources were needed to do any production, we have access to technology. And also there's lots of innovation happening, lots of big tech companies out there, like say Amazon, Microsoft, Nvidia. These companies were not in existence 50 years back, but these companies are carrying the bulk of growth in the market today. And they are giving out good dividends out there. So it's in 1972, if you go 50 years back, from there today, the dividend growth, the growth of the company is almost 21 times. Okay. Of course, the inflation has grown 7 times. So whatever was the cost of goods 50 years back, it has grown 7 times now. Of course, 7 times is not a good number, obviously, but at the same time, the growth of dividend being paid has grown 21 times. So this shows a positive growth in the market, and is always ahead of the on top of the inflation. And the best thing about these dividend paying stocks or dividend paying companies, they always try to at least beat the inflation. So it's always a good thing to be invested in dividend paying companies, because they do beat the inflation. So if you're planning to have a decent retirement and you're looking for long-term growth, then I would suggest that be diversified and look at your portfolio allocation, how much bonds you have, what dividend paying stocks you have. And I hope this update is fruitful for you, and we'll chat to you soon. Thank you. Take care.